Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Last week, Bloomberg Terminal, we were quoted by saying that the Fed is no longer your friend here as we continue to see rates move higher, financial conditions tightening within this pocket of time. Short term, overnight, the news obviously heading into today, we avert a government shutdown. Look, the fight here is legitimate. The worst case scenario for the United States to wind up in right now is a state of stagflation with the spending that we're having. So higher spending, higher deficits, inflation that in particular could remain sticky and at the same time keeps the Fed on hold for longer is not really a good outcome at the same time that we will need to issue more treasuries to fund this deficit. So the fight is legitimate. It is a good thing short term that the government was not shut down, but the basics, the block and tackle here in terms of what's being fought over is extremely important going forward as the rubber clearly is meeting the road here with deficits, financing, and much higher interest rates off the back of inflation. Last week, PCE, very encouraging. We put out a chart over the weekend. If you look at month-over-month readings, which is what the Fed will clearly look at in an environment where inflation has been very volatile coming out of the pandemic, 0.1, 0.2, these month-over-month readings for the core PCE deflator, very, very constructive. But there's not going to be a victory lap here. The Fed, team transitory, is not going to take a victory lap with regard to the inflation numbers short term. They will acknowledge progress, and certainly we have seen that progress. The charts look good, the momentum looks good, and the inflationary outlook, at least within this pocket of time, has been very constructive. Higher for longer real yields in particular, if you listen to Chair Powell, and we will hear from him again today, if you listen to him in his presser, to a certain extent, kind of is telling you they don't really know. We don't know where this magical neutral rate is. But for the first time, he acknowledged that it could be higher. Minneapolis Fed President Kashkari also talking about that neutral rate. There was a lot of talk about the neutral rate heading into Jackson Hole. Our view has been, and we've consistently stated this, with the fiscal contribution that we've seen over the last couple of years, that it is very likely that that neutral rate is slightly higher. And the Fed's frustration that they've raised rates 500 basis points plus here, and they haven't seen the economy necessarily slow in the way that they'd like to see it slow. So that's something to keep an eye on. We focus on the longer end of the curve. We think real yields on the long end is really where market participants should be focused now, piercing through 2%. If you go back historically, and we have 06 to 08 as context, if you go back 25, 30, 40 years, you look at average 10-year real yields, call it 175. We're slightly above that right now. And depending on what your view of neutral is, Minneapolis Fed President Kashkari views neutral, real neutral, as zero. So now 10-year real yields are 200 basis points above that. So we are getting into restrictive territory on the long end in our view. But for a good part of last year and the year before, we weren't, which lends to the long and variable lags. And we have been of the opinion and have expressed this opinion partly through our observations with the economy itself, but also through experience over time. These rate hikes take time to flow through the economy. The consumer is not a mark-to-market vehicle. It's not like trading 10-year yields where you can see the Fed instantaneously move prices and yields and conditions. It takes time for the consumer to absorb not only the increases in rates, understanding why rates are moving higher, where rates ultimately stop, and then how long they're potentially going to stay there. Powell alluded to this in his presser. Perhaps we haven't been restrictive for long enough. We agree. And we also agree that it still pays in 2023 to be tactical and practical. And for a good part of that period of time, in particular, if you look at financial conditions from October of 2022 to where we are now, we are finally now, with regard to financial conditions, moving back to where we were in October of 2022. So the Fed needs to keep the heat on real interest rates. The Fed needs to keep the heat on financial conditions tighter if they're going to succeed in seeing inflation continue to come down toward that 2% target. ISM numbers, what can turn this market around? ISM manufacturing right now, prices paid in the 40s. The manufacturing side of the economy has has been weak. The services side has held up. That gap, that reconciliation in that gap, will it be ISM services coming down to manufacturing or manufacturing going up to ISM services? To date, the manufacturing numbers regionally and what we're seeing in the ISM services this morning, consistently weak, but not only weak, new orders weak, and also prices paid weak. Later in the week, we're going to get ISM services. The market's going to be keen and honing in on that pretty significantly. The ISM numbers historically have correlated very well with 10-year Treasury yields. And then the employment number that we're going to get on Friday. We're still producing jobs. If you listen or look at the claims numbers, continuing claims in particular, these are not numbers that point to a significant weakening of the job market. So 100 to 200 jobs per month, still constructive for the U.S. economy, still keeps the Fed on their toes. With the government shutdown now out of the way for the foreseeable future, any short-term data may now refocus on the November meeting versus the December meeting. We still view it at this point as a coin toss. Key data later in the week, the employment number, expectations are somewhere between 150 and 200,000 jobs. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.